Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over some information on Twitter. I'm going to give my financial opinion and kind of show some differences of opinion maybe on some of these things and give you the data, and you guys can make up your own opinions. Again, if you need any help with this commodity bull market that's coming along, definitely sign up for finding-value.com Platinum membership. And if you want to follow me on Twitter, you can do that. It is at finding_finance. So I'm going to start with this first one. This guy posted this. It says, if inflation has peaked, how long does it take till it normalizes? He says roughly 2 years, according to one historical benchmark, according to Apollo analysis. And this is what he's talking about, the CPI. We've got the 66 to 82, how this came on back. In the 1970s, it took 2 years for inflation to normalize. And one thing that is different, and I brought that up before, is this is the demographic here. And the demographic in the 1970s had this large pullback in the demographic. Now, does that mean that that large pullback had an impact on inflation? Maybe. I'm just going to say maybe, because this was the baby boomers coming into home buying years, and there was a pullback in the demographic in the mid 1970s. All the way till about add 30 years to this, about 1977, that demographic came back. 1977, that's when basically the demographic came back into those home buying years. And if you look at the housing inventory during that time frame, here's your housing inventory of new single family months of remaining inventory. In that time frame, we saw that the inventory really dramatically increased over 8 months in 1974 and didn't come back down all the way till about 1970, I'd say below 6 months, about 1976, 76 or 77, it came back. And then we had another increase in inventory. So that dip in the population or the demographic may have impacted the way the demographic interacted with the real estate market. And the real estate market back then, at least, is what drove the new home builds, is what drove the loaning volume, which was the inflation in that system. And you can distinctly see 3 waves here. 68, it came up into a weakening period in the early 1970s, strengthened, and we have these waves. In my opinion, those waves were partially driven by the demographic here of these 3 humps here. And the 3 humps, it didn't come because, well, this is what I'm trying to figure out is people say, well, the waves of inflation came in 3 humps. Well, the 3 humps came from the demographic because the demographic had 3 humps coming into home buying years. So what I'm trying to say is that the demographic is what was driving the inflation. Now, during that demographic, we also had the existing months of inventory go up and down during that time frame. And right now we're at 2 months, a little over 2 months. And it could go up, but we're in the middle of an expansionary phase, and the demographic right now is pretty solid all the way out till, I'd say, mid 2020s. And that's with the average home buying age being 34 years old. So is this going to repeat like this, or is this amount where it came down to going to be, somewhere like here or not as far down? If when interest rates pull back, we get the housing market to kick back on. I don't know. We don't have any data on that, but we'll have to see and watch and see how this all responds. Here's Lynn. She posted about the platinum to oil ratio. I thought that's a cool ratio. And the platinum to oil ratio is bottoming and coming up, favorable for platinum to outperform oil in the short term. So I think that's kind of cool to see that. I've posted some stuff. I said, are you ready for what's coming? Ratio charts are very cheap. And what this is it's a double bottom of silver when you price silver in relationship to the S&P 500. You get the lead-in pattern, and then you get the double bottom. And this is on a very long time frame. So this may take some time to play out. It may not. But I've accumulated back here 2018, 2019, all in this bottom in here. And I accumulated here recently. And I'm investing in this for the long term. We also see this same pattern developed on the gold to S&P 500 ratio chart as well. There's your lead in, your double bottom, and then I think this will eventually work its way on higher. We also have pattern recognition. This is from Ethereum. I grabbed Ethereum. I'm just using it as a pattern that shows us how the herd mentality trades. And you can see that this is definitely a bottoming pattern. It's got the same characteristics and movements of a bottoming pattern that Ethereum also has. And that's where I took that. It's the cycle, the consolidation cycle, and the consolidation cycle. Now, that means the big run-up. This is what it means and why it's so important. The run-up in gold versus the S&P 500 happened in the 70s. It started in the late 60s when it was freely traded. That's when it really started to take off, and it peaked in early 1980. Then we went into a consolidation phase, and it's been consolidating the entire time since that 1980 peak. The 2000 to 2008 was a mini boom in the consolidation period, and we bottomed again here just recently. So gold and silver in relationship to stocks are at some of the cheapest periods ever in history. And if the market conditions coming up are supportive of a commodity boom or higher inflation or higher interest rates, I think that the same conditions are existing where this could go and revalue itself far higher in the future here. So that is gold and silver, a very big bull on a long-term time frame. This could happen very quick. It may not happen very quick. But it does look like we're the herd is putting the bottom in for gold and silver against stocks. I posted another one. The Baltic Dry Index says China reopens and the Baltic Dry Index looks juicy. Nice falling wedge. So if I open this up, what I did is I took the blue line here of the last bull market and copied it over the current bull market. We have the falling wedge here. So I zoomed in on the right-hand side, and I'm just showing you how similar that this movement is. This peak is this peak. That peak is this peak here. And then you've got the final hump before the Baltic Dry Index really took off. And here it looks like this is ready to take off. We've got the three humps. It's a falling wedge. They usually break to the upside, which is already broken. We could get a little retest move or something like that, a little pullback, and then it could fire off. So the way that people are interacting is the same way that they interacted in the 2000s bull market. And we are at a position in a lot of these, we'll call it sectors, precious metals, whatever it is, we are basically lining this up. The herd is lining this up for a big bull market. I'm also showing everyone about the booty bottom. So I took Ethereum. I just used this to show you a consolidation pattern in Ethereum. It doesn't matter what is being traded. What matters is the general overall pattern. You get this kind of A, B, C correction with the bottom. I call this the double booty bottom. Then you get a pause point, usually either underneath this or right above it, and then a huge break right after. And we're seeing this double bottom. This is kind of what it looks like. You get this neckline here. There's the lead in there, bottom, second, and then you go. And we're getting that in copper, the double bottom. We're at the pause point right before it usually breaks to the upside. We got the same thing in rare earth metals. And it's okay if this pulls back a little bit. We're putting in some sort of wedge type consolidation before potentially a big move to the upside. So the herd is lining this up across the board. And I just chose two of them because I can only post 4 charts here. But this is also in many other sectors. It's in diversified mining companies. It's in base metals. It's in copper. It's in nickel. It's in all these different things. It's not just in these here, but I'm showing some of these double bottoming patterns. A lot of the companies in shipping also have double bottoming patterns. In energy service companies have double bottoming patterns, on and on and on and on. I also showed Camco. Camco behaving this bull cycle like last. See the cylinder formations. Clear as day with the consolidation in between with the three humps. Overlay with the Livermore cylinder from another stock. So what I took is I took the Camco chart. This lead-in pattern's the same as this lead-in pattern happening. Could we get a little bit of a pullback? Maybe, maybe not. That is where people think, oh, we could have a recession. During that recession, the last one, it pulled back 49% from its peak. So it could pull back a little bit more if we get headwinds in the market, which nobody knows if we are or aren't going to get those headwinds and when exactly that will come. In my opinion, I think people are early in predicting some of this stuff. And again, I could be wrong. But usually what happens is rates pause for a good time. So if they stop pausing, I don't know, next quarter or something, they raise it one last time or something like that. And then they pause for about a year, 8 months, year, something like that. That brings us to the end of 2023. That is when potentially something could happen, or maybe not. Maybe inflation comes back and we have another stent and it delays it and the yield curve inverts even further. Difficult to say when that will happen, but on Camco here, we've got the three humps, the consolidation period. We've broken out just like last. And if you zoom in on the right-hand side, we do have Livermore's pattern, 1, 2, 3, 4, 5, 6, 7, and we could break at any point. Could there be a drawdown right before we break, kind of like a false breakout type move? Yes, we very well could get that. And that's an overlay of another pattern, the Livermore pattern on Camco. So we have the same characteristics, the humps, exactly like we do now. And if you were to kind of line this up quite well, it even falls in line pretty close to where we are today. Now, I'm not stating that we're just going to go straight higher like this pattern is suggesting. What I'm saying is the pattern's there. That is what I'm saying. It's there, and it's something to consider. Here's the 10-year yield has bottomed, and it's moving higher. Nothing moves in a straight line, but it's been strong recently. So this is the 10-year yield on a decline from the peak of 1980 all the way to the bottom of 2020. We've broken out of this declining interest rate environment. There's a new shift to increasing rates. Is that coming? So I zoomed in on the right-hand side here, and you can see that it's been very strong. Not too many pullbacks here. We also have a bullish piercing where we could head higher with this hammer pattern on a monthly candlestick basis. This still could go higher, guys. So, and we've had a crazy move off the bottom of 2020 in terms of interest rates and the speed at which it has increased. Now, another thing to keep in mind, and I'm talking about interest rates here, is, there could be problems around the world with bond markets. Go look at Japanese bond market. Go look at the gilts. I mean, they're saving it. They're stick saving every single one of these. Stick save means you throw your stick behind, it hits the puck, and you stick save it from a goal. Luckily, stick saving it. They're kind of stick saving these bond markets, but I think they're going to have problems with currencies and bond markets going forward. That could have a domino effect into other things. So as people are afraid of a recession, they could be trying to generate more demand for those bonds. So with those bonds, like the gilts and the Japanese bonds, and the problems that they potentially could be having over there, and all the quantitative easing they're doing for Japanese bonds and all the bond buying that they're doing, I wouldn't touch bonds. This could be a domino that just flings and starts everything into a bond market crisis or currency crisis or both. Are we at the beginning of that? It sure looks like it. I like precious metals, no counterparty risk, and they all are very cheap in relationship to everything else. So I don't see the downside to owning physical metals, but I could see a massive downside in bonds. And I know people, they think that recession's coming and that the old playbook's going to work, that bonds are going to be the spot to be. I'm just saying it might not be. That might be the most dangerous thing to be holding. more dangerous than even some of the stocks. But I don't know. That's my opinion there. So moving on, we go to some other chart patterns that I have here. So I've got gold, again, the 3-hump consolidation, and then the false breakout to the downside and the move higher. We could see this in other, even in oil, we could see a 3-hump consolidation, a false breakout, and then a move higher, which could happen kind of across the board. But that's what gold has right here. I think we do move higher, or we could pull back and do a retest out of this breakout. It's possible. We also see, this is the pattern that I'm talking about, the 3 humps, the break. We're seeing platinum, the 3-hump consolidation period, the false breakout, and then the breakout retest. And to me, it looks like platinum's ready to go higher here. Good momentum, good solid closings. We've got silver. Silver's been basically stuck between support and resistance. We've got a consolidation period with the double bottom that we're happening in terms of dollars. We've got the slingshot where it did this 2020 kind of false move down, slingshotted it higher. This can happen too. We could very easily come up, have a little recession. Maybe that recession comes and brings it down to 27 or something out in the future. I don't know exactly what the future has in store for us, but this has a double bottoming pattern, a move higher, kind of a retest to that support level, and we've got resistance at about $27. And this is the overall commodity index that I posted. So this is the CRB index. And what we have here is the start of the move. That's our buy signal for commodities to stock ratio. We've come on up and we've done a falling wedge. In that declining wedge, we've got 3 humps and we're starting to break to the upside. Is this a false breakout to the upside before moving lower? Are we going to run higher? That's yet to be determined. And I just showing that same wedge type formation that's basically happening in the CRB index here. It's a falling wedge. It usually breaks to the upside and runs to the upside. It's a continuation pattern. So that's the index there. And then I did a overlay of natural gas with the Livermore cylinder, kind of how that's all aligning up. This is Bitcoin. Bitcoin, first yearly bearish engulf candle ever. So this is engulfing the one before it, where it could be putting in a topping pattern to head lower for Bitcoin. Looking at this, it says we also see this in the evolution of gold versus U.S. government bonds. So you look at gold versus government bonds, it's breaking out against government bonds. Gold is. So that also means something, and it does look like a very strong breakout. And this could be a leading indicator of what to see when gold is priced in other assets. We also have this. I think this is kind of interesting. It says, let's see if China works in 2023. Liquidity injected by the PBOC, Bank of China, in December. GDP momentum bottoming possibly. So we've got the open market operations here, and we see the GDP momentum. GDP, since they were on basically lockdown because of COVID, we've got to a very low level in terms of liquidity injections, and they just pumped this thing. So that, I think, is pretty good for commodities, as China is a commodity consumer. So we do have liquidity being pumped into the system over in China. And I do think that GDP momentum will turn up with that liquidity injection. And you can see the relationship here. They inject liquidity, and then the GDP follows of the black dotted line. And then as liquidity falls, GDP falls with it. So there is a large injection of liquidity, and I think GDP will follow, which could put stress onto oil demand and other commodity demand. And I think that's what we're seeing in a lot of these charts, is people are lining that up to move higher, the commodities. Here's one. It says this oil and gas bull market still has lots of room to run, particularly for smaller caps and energy services. This is basically kind of a trend line that somebody had thrown in here. And we got so far off the trend line here that we can go up quite a bit to eclipse the trend line and then go above it, especially above it like 2008. So we were in a very cheap area in 2020 in relationship to the trend line. This is the S&P energy over-under trend line growth. We can see that we were way outside of that trend line. And to get back to an overvalued area, we have a long way to run. So still a lot of value in energy. Here's one, says U.S. households currently have higher than average equity exposure, red line, and lower than average real estate exposure, blue line, as percentage of their assets than their 70-year respective historical average. And you can see back in some of these other ones in the 70s, people had a lot more real estate market value in relationship to their equity value in these areas. It radically diverged in that time frame. Now we've got a lot more equity value than actually real estate value. So that's an interesting thing. That's what I'll say. And that money could rotate over. We'll see. But historically, that's where it's at. Here is the Bank of Japan has purchased about 128 billion of bonds in December. This is what I was talking about. It's a monthly record and how their bond market might be in trouble. They are really coming out and hitting the printing press, and that's going to have I think, an impact on their currency value. The more that they start to buy over here, I think the worse it's going to hit currencies, and this could be a domino in a bunch of different problems in bond markets. I'm not a big fan of bonds at this time. I'm definitely a big fan of precious metals. I'm sure everybody understands that if you've been listening to the channel, but there could be problems out there. Some promoters like to make much of LME inventories. Maybe this time it means something, but we've seen periods when inventories and metals prices fell at the same time. So beware of any related hype. And I think that deals with liquidity versus physical demand. But right now, LME inventories have plunged to the lowest levels in the last 25 years. So we're at very low levels, and this is for stocks of aluminum, copper, nickel, zinc, lead, and tin. Very, very low levels. Here's EOG Resources 2022 drills show a substantial decline in normalized well productivity as reality bites on their double premium well inventory. What this is showing us is that over time, what they did is in 2018, it's the green line here, that's their well productivity. And it increased in 2019. And now we're starting to see declines from 2020, 2021, and then 2022 is way down here. So when grouping these wells, we're seeing a large decline in well productivity over time. Here's also something that's kind of weird. M2 actually shrank this year, and I think that deals with lending and other things, but M2 has shrunk, and it's the first time in a very long time that M2 has shrunk. Could this eventually lead to a pullback? It very well could. But it depends on where that money's coming out and how it's coming out. Because we've also seen an increase in money velocity along with this M2 money supply shrinkage. Natural gas is now at its lowest price since the end of February. We've got this nice little coming to a point corner here. And that could be a reversal point. And I also show some of that in terms of the three hump consolidation and then the last kind of blowout bottom. So that's what I've got for today, guys. That is, hopefully you guys enjoyed it. Give me a thumbs up. Subscribe to the channel if you haven't. Check out the website if you'd like. You can use the word discount in the coupon code to get a discount. All right, guys, that's all I've got for today. Thanks for listening. This is Finding Value.